We've got a short week owing to the bank holiday Monday, and even after that, corporate news is pretty thin on the ground, with Johnson Matthey the only FTSE 100 firm scheduled to release results. You can, however, watch out for the latest FTSE 100 index constituents reshuffle on the 31st of May, when the FTSE 250 will also be revised. So far as the 100 goes, retail commercial property play Intu looks like it could well be relegated, while recovering support services specialist G4S, fellow real estate investment trust Segro and house builder Barclay, well, they're all jockeying for promotion back to the top flight. However, the market's attentions may switch toward the macroeconomic news that's due out during the week, given the paucity of company updates. And the key items of note are the Purchasing Managers Indices, or PMIs, due out in the UK. On Thursday the 1st of June we've got manufacturing, and Friday the 2nd we have construction, with services actually due on Monday the 5th. These PMIs are monthly surveys of UK companies. They take a snapshot of output, new orders, stock levels, employment and prices to build up a quick picture of a particular sector and the overall economy. They're based on hard data that's generally more timely than many official statistics, such as employment or GDP growth, and they can give some insight into what may happen in the future. Generally, a reading over 50 is seen as indicative of future growth, because current trading is good, so firms may invest more or hire more, while one below 50 could point to a slowdown or even a recession, as companies may start to retrench if current trading is tough or turning down. This next graphic shows the trend in manufacturing, construction and services since the start of 2016. Note that post-referendum dip, subsequent recovery, a winter wobble, and then fresh strides higher in spring 2017. The key will be to see how the May readings compare to those of April, which were, for the record, 57.3 for manufacturing, 53.1 for construction, 55.8 for services. This now, of course, all begs the question of whether the PMIs are reliable indicators for the economy or not, and therefore whether you should pay any attention at all. We've therefore gone back to 2005 and tested the PMIs against other data that come with a lag, and, slightly to my surprise, they do look to be a pretty good guide. On each occasion, we've used the average PMI monthly reading for the 3 separate surveys. The first chart here runs the average PMI against year-on-year GDP growth on a quarterly basis. Not bad. The next one also looks like a decent fit. Monthly average PMI data set against monthly job creation or job loss numbers. Though note how the employment figures lag the PMIs by a good few months. Again, PMIs are lead indicators, jobs are lagging one. The PMI also seems to act as a good lead indicator for wage growth, at least judging by the last 12 years' data. Also note how the average score compares to the start of month level of the FTSE All-Share. Now, correlation is not causation, but short-term traders do seem to pay pretty close attention to the PMI results. That said, we do need to bear 2 things in mind here. First, 2/3 of the FTSE 100's earnings come from overseas, so the UK PMIs may be of pretty limited interest to them, and they are, of course, more than 80% of the FTSE All-Shares market cap between them. Second, the PMIs can clearly create short-term noise, but long-term investors, and especially income seekers, may just want to block that out. Remember, only 26 FTSE 100 firms have grown their dividend every year over the past decade, and every single one of them has outperformed the index on a totals returns basis over that time span, with Bunzl at the top and SSE at the bottom. They've sailed through the great financial crisis and kept on going. The short-term ups and downs of the UK economy have not blown them off course. So if you are going to pick your own stocks rather than let buying an active fund or an index tracker take the strain for you, then these may be the sort of firms you're looking to seek out. They have, after all, pricing power. This is a concept to which I'll return in future blogs and videos. But in the meantime, by all means follow the PMI surveys if you're a trader, though please be aware of the trading costs, spreads and other fees you'll incur. If your style is longer term, and that helpfully keeps your costs down for starters, then you may not be looking too much at the PMIs, but more at companies' business models, their finances, and what makes customers buy their products and services and willingly pay for them. Thank you for watching, and I look forward to seeing you next time.